People love to say cash is king, but here's the truth. When it comes to building wealth, credit is often more powerful than cash. Good credit can open doors that cash simply can't alone. It can get you into a home sooner, save you thousands in interest, and give you leverage that accelerates wealth building. And I've seen firsthand how not understanding the power of credit can keep people stuck. Hey, I'm Shakima, realtor, wealth educator, purpose coach, and founder of The Wealthy Me. I help purpose-driven individuals over 40 shift their money mindset, build sustainable wealth, and make smart financial decisions with confidence. So today I'm breaking down why credit matters more than cash in many cases, and how you can start using it as a tool instead of fearing it. So let's start with the basics. What credit actually represents and why it matters so much. Credit isn't just a number, it's a trust score. It tells lenders how risky or reliable you are with money. A high score means opportunity, low interest rates, better loan approvals, even job and insurance benefits. A low score, it limits your options. It costs you more and it keeps you financially stressed. For example, a 760 credit score might get you a mortgage rate of 6.5%. A 620 score could push you up to 8%. On a $300,000 home, that difference equals around $350 more every month and over $125,000 across the life of the loan. That's the power of credit. So does that compare to having cash? Let's break it down. So let's say you have $20,000 in cash. You can buy a car outright or you could finance it. If your credit is excellent, you could finance it at, say, 4% interest rate, meaning your payment is manageable and you still keep most of that $20,000 cash. That money could be working for you, invested and earning about 6 to 8% a year. But if your credit is poor, your rate could be around 12% or higher. Suddenly, financing becomes a trap, and that same car costs you thousands more in interest. So 2 people walk into a dealership. One with cash but bad credit, one with cash and excellent credit. The one with better credit walks out wealthier in the long run, even if they didn't drop all their cash in day one. And credit doesn't just affect cars or houses. It affects almost every financial decision you'll ever make. I remember one client who thought, as long as I have cash, I'll be fine. They avoided using credit altogether because they were scared of debt. When the time came to buy a home, they had money saved, but their credit was weak. The lender denied them, even though they had $25,000 in the bank. Why? Because lenders trust credit history more than lump sum cash. Research shows that people with strong credit not only pay less in interest, but also have access to higher limit cards, business funding, and strategic debt that builds wealth. That's why I say cash is important, but credit multiplies your opportunities. So if credit is this powerful, why do so many people ignore it? Or worse, fear it? A lot of it comes from myths we've been taught. So myth number 1, all debt is bad. We've been told our whole lives that debt is dangerous. And yes, it can be. Maxing out credit cards for shopping or payday loans are financial quicksand. But not all debt is created equal. Strategic debt can build wealth. A mortgage is technically debt, but it allows you to own a $300,000 home by putting down maybe $15,000. Over time, that home can appreciate and you're building equity, something you'll never do just renting. So the question isn't, is debt bad? It's, is this debt building me or draining me? Myth number 2, paying cash is always better. Here's the problem with paying cash for everything. Once it's gone, it's gone. you can't get it back. Let's go back to the car example. You buy a $20,000 car in cash. You now own it free and clear, but you've also emptied $20,000 from your account. That money could have been earning 6 to 8% in investments. Now imagine instead financing that car with good credit. You get a low 4% rate, make manageable payments, and keep most of that cash in your account. Over 5 years, the investment growth on your $20,000 could actually outpace the interest you paid. Cash feels safer, but credit can stretch your money farther. Myth number 3, credit is only for rich people. I've heard this so many times. I don't need credit, I'll just use cash. But credit isn't about being rich, it's about being prepared. Landlords check credit. Employers sometimes check credit. Insurance companies check credit. Your credit history can affect opportunities long before wealth enters the picture. And here's the irony. If you don't use credit wisely, you'll pay more for the same things. A person with poor credit might pay $350 more per month on the same house compared to someone with excellent credit. That's not a luxury problem. That's real money out of your pocket. Let's flip the script. Let me show you exactly how to make credit work as a tool. Tool number 1, understand and manage utilization. Utilization is just how much of your available credit you're using. So for example, if you have a card with a $5,000 limit and a $2,500 balance, that's 50% utilization. The goal, keep it under 30%, ideally under 10%. So on that $5,000 card, that's under $1,500 or better, under $500. High utilization makes you look maxed out even if you pay on time. Tool number 2, pay on time, every time. Payment history is about 35% of your credit score. One late payment can drop your score by 100 points. Use auto pay, calendar reminders, or budgeting apps to make sure you never miss. Tool number 3, build and protect your history. The longer you've had credit, the better. Don't close your oldest card. Instead, put a small recurring charge on it. For example, use something like your Netflix account and pay it off monthly. That way, it stays active and helps your score. Tool number 4, use leverage strategically. This is where credit creates wealth. With good credit, you can buy a $300,000 home with 3 to 5% down and let appreciation build equity. Or you can access business credit to launch something without draining your personal savings. So here's a quick exercise. Grab a piece of paper and answer these 3 questions right now. Question number 1, what's my current utilization percentage? 2, do I have auto pay set up for all my accounts? And 3, do I have an old card I've thought about closing? And should I keep it open instead? Answering these today can help you save thousands tomorrow. And once you start applying these tools consistently, you'll see why credit isn't something to fear, it's something to master. Cash is valuable, but it's limited. When it's gone, it's gone. Credit, on the other hand, gives you leverage. It saves you money and interest. It gives you access to opportunities cash alone can't buy. And it protects your liquidity so you're not cash poor while trying to build wealth. In the wealth building game, credit is often the difference between just getting by and moving ahead. So yes, cash is important, but credit is power. It can be the bridge between where you are now and the life you want to build. If this episode resonated with you, hit like, subscribe, and share it with someone who needs to hear it. And check out more videos right here on the channel. I've got plenty of content to help you shift your mindset and grow your wealth with confidence. I'll see you on the next one.